All right, good afternoon, everybody. Here, this is Gavin McGuire, aka Event Trader, being joined by Brett Manning, Chart Trader. Brett, that you hear popping on at the moment?
Yo, how you doing, Gav?
I'm doing good. How's your day treating you?
Doing pretty good.
Okay, let's kick off real quick, Brett. Uh, we talked a lot about the robo ratio and positioning yesterday, and the idea that we could get some quick shakeouts ahead of the Fed, just a little bit of perhaps selling, a little bit of pullback on the bullish call activity,
I'm thinking you
particularly.
mean last week,
Yes, what did I say?
yesterday, but that's
Oh,
okay. It
the
feels
last
like
week. I'm
yesterday.
sorry. I'm sorry.
It
The,
does.
the summer just kind of melts together here.
Exactly right.
But yeah, sorry. Last week in our last show, I should say. But and basically we talked a lot about the retail only crowd coming in here, and the idea that there could be a little bit of shakeout selling ahead of the Fed. And I wanted to bring that up because I really feel like the last 2 days we kind of saw a pretty good showing of that thought process. Do you think that's what we're seeing here over the last 2 days? Because we had that early selling, and then real quickly that buy the dip came in, and I know you were talking about that buy the dip this morning.
Yeah, so I mean, I think that today was just a pretty straight, Trump shakeout on trade, and I think that there's problems elsewhere as well, and we're kind of setting up probably a little bit of vulnerability with the Fed, possibly starting to look. I know Dudley, wasn't it? Dudley was out this morning saying he thinks it's going to be a one-off insurance cut. So there's a big kind of
And
horse trading
Dudley's
prep around
no
that
longer
theme.
Dudley's no longer on that
I know.
FOMC. I
I
know. I'm just making sure people
Okay.
are aware.
Yeah. Right. He's the former New York Fed head,
Yeah.
but he just basically came out and said straight up that, oh yeah, it looks to me like a good opportunity for a one-off insurance cut rather than a series of cuts or an easing cycle. And I think that, like we talked last week, I think that's the big drama that's in play. Everybody
Right.
knows you're going to get 25 basis points, and the question is, are you going to get 25 now, 25 in September, 25 in November or December, maybe even 25 more in next March, even if we continue to see the United States economy basically performing well, but with a flatter inverted yield curve. And that's the big question. And people aren't sure. It's a tremendously advantageous opportunity, long risk assets, if we're going to see that much of a prevention-minded Fed. And there's enough money, as we've talked ad nauseum over the last 6 to 8 weeks. There's been a tremendous flow to the sidelines in risk capital where equities are concerned. So that sets a kind of powder keg up for a big blow-off move to the upside. Blow-off or not, I'm not sure, but a big move to the upside if we get a serious easing cycle with a strong economy in a situation where people are underexposed. So there's the big question out there. Otherwise, you get your one-off insurance cut. And we're going to talk more about that, I'm sure, over the course of this segment and our thoughts about that. But I think that's the big drama that sits in front of the market right now.
Yeah, certainly that'll be a key item that we'll touch upon. We'll get into the sentiment and flow data here now because really, from my perspective, I didn't see a big change in what we were looking at from the prior week. But let's take a look around and see what was going on here now. On the optimistic side, it still remains relatively high, I thought, in terms of the number of ratios that we're going towards that side. Now, again, I know a lot of them don't usually show up into your list, Brett, for what you have on for your favorites. But real quick, and just looking at the sentiment indicators, I had 44% of the indicators were now in the showing optimism range, which was up from last week, which was about 37%. Only
Right.
one is in the pessimism range, and that would be the mutual fund flow. So right off the bat, and we'll get breaking each one of these, was there any overall theme that you saw that was really all that different from the prior week in terms of the sentiment data?
Yeah, so I will say, as a general rule, the devil's in the details. And the nuance is the important part. You can use statistics to justify any perspective, but in my experience, there's a couple of things that I saw over the last week that give me pause about trying to short the market again. One of those, so there's a sequential data point that you can abstract from all of this, which is in a persistent trending environment where you've got a kind of wall of worry situation where people are maybe too skeptical or pessimistic relative to what the market is doing, which is a kind of typical bull market posture where people can really kind of drain themselves dry trying to pick tops. That kind of market tends to be also characterized by the idea that some of these sentiment data points are quick they approach extremes, and with very little they move way back toward pessimistic or way back up in the middle. And I think that we're seeing a little bit of that flinching kind of behavior in some of these things. Like on a week where I would have thought Robo would have been moving to an extreme, it bounced back the other way. Same goes for several different indicators. And the one that we've been looking at more recently, the option speculation index, pulled back quite a bit in a situation where there really wasn't any kind of obvious call for that. It just did.
Particularly,
hedge fund exposure did the same thing.
Let me ask you this, Brett, with that Robo ratio, and because it seemed like that was where most of the polling came in. I had the Lobo as flat from the prior week, and the Robo ratio had pulled in about six basis points. So again, would you look at a lot of that selling last week as perhaps some of these retail-only people covering their calls?
Yeah, well, and sort of in an unprovoked way, and maybe it's kind of into the Fed. I don't know, but it's just the idea that it never was able to cleanly move into an extreme territory. And when you have a situation where I think you're getting past some uncertainties and kind of getting some positive information into the market, they pull back a little bit. And the option speculation index did quite a bit more, and the hedge fund exposure index did quite a bit more. Whether or not that's perfectly aligned with exposure is a question mark, but the idea of showing up the degree to which there's perfect correlation between the S&P and some of the hedge fund tracking indices as a feed through to understanding what their exposure is, that pulled back quite a bit. But it's just a kind of sense, and I can't explain this other than sort of an inductive reasoning point, a qualitative kind of just gut feeling that I've had from watching this data quite a bit. And if there's a value add there, hopefully that's a good one, because I've watched this data obsessively for about 18 years. And yeah, there's just this little kind of quick twitch pullback on a lot of these different indicators in a situation where it just doesn't feel to me like that's what you should see if we're growing toward a kind of serious and red flaggish sort of extreme of overexposure and complacency. It still just feels a little bit shaky. People sort of start to take some risks. They get on board with taking some risks. They get involved a little bit more. But then sort of the first pause, they jump back to the sidelines. And there's a little bit of a quick move like that. And that kind of feature, and it just feels like again, it's sort of a gut feeling, but it just feels like that's the sort of context we have now, which is a prefatory step to starting to see the more dangerous stuff. And it gets a little bit more robust, and people get a little bit more like, it's like somebody stepping into hot water and realizing it's not hot enough to really hurt them, and then they start to get comfortable in the bathtub, And at first, right now, they stick a toe in, it's a little hot, pull it back out, and they're pretty soon they're going to be just lounging back in there with a newspaper, and we're going to start to boil. And that will get there, but it's this, we're not quite to that, that phase of the process as far as I see it in this data.
Right. Now, we're not to the other side of the process either, which is just leaving the bathroom because it's never going to get hot.
We've left I hate the bath. Yeah, we're away from that. We're starting to go, well, maybe a bath would be pretty good, but, it's a little bit warm, So we're kind of there, and we're somewhere along the path toward building to that. But I feel like we need some kind of, maybe the Fed signals the easing cycle and the market blows off to the upside. Apple does great. Who knows what it is? Something that just kind of triggers this, like, oh no, I've been left behind. The stock market's the place to be. And you just kind of feed off into that move, and everybody's on board, and then it starts to tick down on a good piece of good news, and that's it. The party's over. So we'll see if we kind of build into that. But I feel like right now it's still keeping me real wary about, especially shorting into a hole on a news-driven gap down like this morning.
I tried going the opposite with shorting a pop in the news that.
You managed it well, though. You managed to take your shot and not get hurt in a situation where the context was just what I just described, which is
right.
Which is great. You can take a shot and not get hurt. There you go.
And the reasoning behind my looking to take a shot is I do think that given some of the recent economic data, and we'll get into the Fed in a little bit, But I just think that that's going to be a little bit of a sell the news reaction, and we could break into some of the different scenarios here in a little bit. But I think taking a look at some of the sentiment data and flow data ahead of time before we move into that, so we could get a better idea of where we stand. But really, I think, Brett, for the most part, is that we're in the same boat as last week, and we just haven't, like you were saying, found that fundamental catalyst for jumping above that level. I do think that the earnings are supportive that we've seen so far for getting above that level. Now we do have a lot of the C students, if you will, the ham and eggers, as I like to call them, coming out over the next week, and I'm just curious to see if we could kind of keep that cycle in, or if some of those weaker names really show. It's kind of the wave coming back, and the Emperor's got no clothes on at this point of the earnings season. It's going to be interesting to see who's got the swimsuit on and who doesn't, I feel, over the next few weeks. And I wonder, Brett, do you think we have the narrative already set for earnings, or do you think that there's still enough out there to possibly change it? Obviously, Apple tonight could play a big factor into that.
I mean, I think it's calcifying, but I think – let me ask you something. So a couple of weeks ago we sat here, we talked about a possible theme for this earnings season, and I want to get your answer as to whether or not you think, if you pan back to 30,000 feet, if you think by and large it's correct or it's not, and that is this. Companies see an opportunity right now to reduce expectations for the rest of the year on a narrative that doesn't make them look bad as an individual performer, because they can essentially scapegoat trade uncertainty, and then they can leap gracefully over the bar in Q3 and Q4. Do you think you're seeing some of that?
Now, I would have to roll back and get some numbers for this, and I will go back and I'll have it ready to go for next week's show. I promise that.
Just like your gut feeling, though, conference call.
No, I don't think that they've been lowering their guidance to as much of an extent as I would have expected to see, which I think is obviously more bullish for this earnings season in terms.
You don't think they're taking advantage of the context?
I don't think they are, and I don't know if that's better. If they're not being smart enough, if they're afraid to kind of rattle the markets. But I haven't noticed, like certainly a couple here and there for sure. Definitely, it feels like some of the semiconductor plays have been doing that, but
the railroads. What about like CSX? They seemed a little bit.
Just CSX.
Yeah, okay.
CSX was the worst performer of the railroads. The fact that
it had been about this, there's a mysterious factor that's causing things to be more difficult. But we're doing
I believe the exact phrase was, "It's the most puzzling economy that I've ever seen."
But then he didn't really describe anything that I thought was like. Kind of justified that statement, but all right.
And again, I was keeping a close eye on the rest of the rail names, and they just simply weren't hitting that same tune, in my opinion. But again, I could go in and I could find some numbers about who's guided down and stuff.
Maybe that's the problem with the theory. That maybe the problem is it's a game theory problem. Look at CSX's situation. What if you're the first to run out with your earnings and you try to do that, but you're the only company that does that? Then you really kind of lose your place in the pecking order in terms of positioning in that sector, right? Because suddenly other companies come out and say, I don't know what their problem is, but we're handling it.
Yeah.
You know what I mean? If they were able to coordinate, if they all got on a big conference call ahead of earnings season and said, hey guys, we can take advantage of this dynamic, then that'd be great. But maybe with a macro variable like this, it's kind of tough to get on the same page and everybody's afraid to be the only one who's complaining about something.
Yeah, and again, just a quick glance just at this morning. I know it's not a great subset, but there's probably about 60, 70 names out. There was 9 that warned. 4 provided upside guidance, and then I would say the majority were in line. Again, we could get these numbers out, but from my perspective, I was expecting to see a lot of, like you were saying, a kitchen sink type quarter, and I don't feel like a lot of companies have taken that, and that's just objectively looking. I'd have to take a look. Perhaps I just had really low expectations.
But it's remarkable given some of the economic sentiment surveys that we've seen.
Yeah.
Over the last 60 days, the Philly and even Dallas, Chicago certainly. Like there's been all these numbers of like, whoa, we're pulling back the reins, and then you get in the conference calls and it's not there.
Yeah, it's
Kind of
just
interesting.
simply not there. And then, I mean, you break into the economic data. I mean,
It's definitely not there.
it's definitely not there. It's been, in fact, pretty strong. I mean, just personal income and spending was nice. PC prices remain lower, and we'll get into the Fed there. Case Shiller. That number was a little bit weak, but the consumer confidence number all of a sudden blows out expectations here. We do have the ADP report ahead of the Fed, and the ADP has kind of bucked the trend and actually been a better look at the BLS, Brett. The last, I think, 8 out of 9 times now, the ADP in terms of a beat or a miss has correctly predicted the ADP number. So they're starting to match up, but again, it's not like the ADP is going to post in. We got a 150 briefing.com consensus. I think Pat's
You mean,
got
Jerry,
it.
you're saying the ADP number has beat the analyst consensus in terms of predicting the employment statistics report.
Has matched up with a beat or a miss on the BLS. So if the ADP beat, the BLS is beaten. If the ADP missed, the BLS would miss, and that's
So
been
either
8
the
of the last
ADP
9
is predicting
times.
it well, or the analysts are equally wrong.
Yeah, perhaps, but again, for the most part, the ADP number had been really a crapshoot, and a lot of people look at the ADP number and before it has not been a great predictor at all of the non-farm payrolls, and rightfully so. I mean, obviously, it doesn't include the government jobs and everything. But just the fact that it has been running pretty closely here, perhaps that's because maybe the same industries that are doing well tend to fall into both areas or something. I don't know.
I'm
what
inherently biased. I'm inherently biased against ADP because my wife ran a technology company and she did their payrolls through ADP, and they were the worst customer service company I've ever seen before in my entire life.
Have you ever been to the?
Be my guide.
Have you ever been to the DMV?
Oh, ADP is worse. It's amazing how bad they were. There was lawyers involved. It was
all right.
awful.
That's good to know. So we'll just look for manpower to see if they have
anything.
But I suppose that'd be mostly
so
following European.
I can see incompetence across the board as an explanation there every time.
But again, and I guess this will all factor into our Fed discussion here. The earnings data, from my perspective, and again, I'll get solid numbers and I'll post on that, has been better than I've expected it to be for sure.
Which?
As the earnings overall, which was your initial question, has just been better than I would have expected. And again,
look at the Q3, Q4.
Right, and the one factor too, Brett, is I feel like we were talking about that earnings recession, but I feel like that earnings recession is pretty much being dragged down. Again, you got to see what the number is by the earnings space, and I know that's expected to have been the biggest decliner. So I don't know, and everybody knows earnings there have been bad. Look at the XLE or any of those names. So for me, I think that it falls into the bullish category for earnings season so far, for sure.
So we should see the market reacting better to the upside, possibly? Is this a fair sign?
Well, I think that
what if we're setting expectations too high and the whole situation's still going to come home to roost?
Well, that would be a Q3 issue, and by then,
right. I mean, if you have a sandbag,
by then I allow the ability to turn my decision here. But I mean, right now it just comes all into the idea that I do lean bullish in the markets here going forward, with the caveat being the next couple of days could be a little bit of a downfall, and that's why I've been trying to play some shorts.
Right. Okay.
So, all right. So, with the sentiment data, Brett, is there anything in particular that you wanted to touch upon that we haven't talked about? We talked about the option speculation, which, from my perspective, it seems to be a lot of those robocalls pulling back above their head, and I think that's been the catalyst for why we haven't been able to see a breakout. But is there anything else that you're looking at that you have your eyes on from the sentiment side?
I mean, the currency markets are a little interesting right now because obviously you've got the pound completely blowing up.
Yeah, the pound's a complete nightmare.
And I think that's just been a really slow motion train wreck for at least 6 months now. And it's an interesting lesson in markets.
Yeah, but even for the last week, although I guess Boris has been known to be here
Well,
from.
it's just finally people are capitulating to a reality here, I think, and they've just been kind of like a disbelief about the possibility of a no deal exit and how this could all actually conflagrate into something that everybody could see a mile away as the worst case scenario, and still there's 15 different people with their hands on the wheel and nobody can turn right or left, and it's pretty interesting to watch. But I think that one interesting point is all the major Wall Street houses have been out bearish on the dollar for the last 2 months, over and over again, and the dollar keeps roaring higher, and even right into the Fed cutting. And I think that that's one of the interesting signals about the Fed. In front of the Fed is the idea that the dollar would typically start to weaken ahead of a cut, and this is the most telegraphed cut you can imagine, and the dollar is continually breaking higher. And the sentiment situation isn't that crazy, right? I mean, we're starting to rebuild a strong short position in some of the important crosses. It's not insane. It could continue, I think. And that puts us in this difficult position when we're talking about the Fed and when we're judging the overall policy situation, which I see as the solar system, or the sun of the solar system of finance, right? The sun is the dollar, and the policy, fiscal and monetary, that's around the dollar. That's the most important and central issue that everything else revolves around in the whole global financial system. And right now we're heading into a situation where we've got this big question mark that we've talked about. We don't have excessive positioning, as far as I can see, really in any of the major crosses or in the dollar itself. And we've got a kind of situation where analysts have been preparing for a bearish reversal in the dollar, and the Fed is moving into what could be an easing cycle, and the dollar is breaking out to the upside. And that puts us squarely back in a very strange version of divergence. And I constantly talk about this difference between convergence and divergence, being United States versus ROW, or rest of world, in terms of the policy landscape. And when you've got divergence, you have the possibility of a lagged set of problems, particularly involving dollar-denominated debt, but foreign monetary policy, all sorts of things that tend to crop up as different issues. But the Fed is already starting to turn toward easing, and yet we're heading into a more direct version of divergence, which could be a factor. And I always believe that it's possible that this is one of the most important issues for the Fed, even if they never really talk about it, because I don't think that they want to move into a universe. And I think we've seen concrete examples of this, particularly over the last couple of years, but I think even further back, where this is something that the Fed really doesn't talk about, but they really do loathe the idea of a runaway dollar upside that is driven by global financial and economic weakness in particular. If it's driven by everybody's doing great, the United States is doing better, I don't think that's as much of an issue. But when it's a situation where you have teetering toward recession Europe, teetering toward recession Japan, teetering toward recession other countries, and the United States doing okay, then you tend to build up some extraordinary imbalances. And there are ones that I think are sort of in the deep financial plumbing, particularly in terms of swaps, relationships, and all sorts of things. And they don't want to deal with those problems, and they'd rather stay relatively in sync with other central banks. So I feel like the strength in the dollar may itself be something that's predicting a one-off easing cycle, but may actually be creating more than that at the same time. I don't know if that makes sense. Do you get what I'm saying?
Are you talking about just as a safety?
I'm talking about the Fed having an agenda really to avoid a runaway divergence between the United States economy and the rest of the world, particularly one that shows up in outsized dollar strength. That's a problem, and they use policy to try to avoid that problem.
Yeah, and obviously that would mean that they would be in cahoots with the ECB and Bank of Japan. I did find it interesting that I thought the ECB for Draghi last Thursday was a little bit more measured than I would have expected. We saw the euro pop up there, and then the Bank of Japan as well, for that matter. But one has to wonder if they're kind of waiting for the Fed to get this 25 basis point cut and kind of see where we go from there in terms of who wants to be the most dovish in front of like the potential back end issues with trade wars. That's how I kind of look at it right now. I mean, I think we would never get that as the explicit reason for why the Fed was doing. If they were going to move on to it, I think inflation would be the easiest way for them to kind of push on it.
Oh, sure. So, that's the device. That's the explanatory device, and that's an easy one.
Yeah, and I mean that would be, I think, if I did see them talking about inflation, because I haven't seen inflation running as low as some people feared, that I just feel there's certainly the concern about the Japanification of the monetary policy, but I think that would be just kind of code word for we don't want to diverge too far away from
What
the
I
other
think,
central
what I
banks.
think there is, I think the consuming issue is one that's more theoretical. Like at the basis of it, if they have a North Star, if they have a guiding philosophical system that they can turn to or scapegoat or explain themselves with at any point, that's easy. But now there's this sense that the Phillips curve is a failed 20th century idea, and there's a new reality, and we don't exactly know how that works. Seems to be the rhetoric that I hear, and I've never really in my career I've never really seen the Fed in a situation where it seems so lost at sea in terms of what its underlying theoretical basis is.
I think there's another thing too that needs to be taken into consideration. It was interesting. I heard Steve Leisman speaking about it earlier, and I thought it was a really good piece from him, and I think it was a Wall Street Journal piece where they're talking about the Fed's biggest concern is that they are going to completely lose the central bank as an institution under the idea that if they are viewed as the reason for the decline of the economy, if they ruin it, and we know that Trump's been sitting there for the last 2 years, setting that up as the reason for it, and then continues to just hammer on the central bank that we don't need it, they ruined it, and with the populist following that they have there, does that ruin the central bank and the Fed as a whole? I mean, everybody thinks that, well, the Fed's always going to be there. It's only 107 years old or whatever for the institution. It wasn't until J.P. Morgan had to save the entire United States economy back in 1908 or whatever it was that the Fed was first started putting together.
Of course, we had a recession every 2 years for 50 years before the Fed.
Yeah, and we've seen Turkey, of course. Now, Turkey obviously isn't the dollar reserve, so I'm not comparing the two. But I think that the Fed is in an area where they are afraid of being too tight and being the reason for the economy slowing down, because we know that they're going to get blamed for it, that they would prefer to. They don't want to have a tendency where they mess up and they have a policy mistake because they were too tight. They would rather have it be too loose, and for inflation to kind of run away, and for them to be like, well, the president wanted it to be this way, and now this is what's going on here. I'm not saying that they would use it, but the general idea is that there's a little concern about the institution,
existential fear.
Yeah, being run down, and for them to see a populist backdrop where the economy falls off. Trump blames the Fed, and the Fed's basically run out of town on the rails, and they don't want that to happen. So you got the diversification from the other central banks, and then the idea that the Fed doesn't want to be blamed for choking off with a policy misstep for being too strict. So what do you think of that?
Okay, let me respond. So I think that we're going to go off on this exploration of this idea. I would say that again, I think it goes back to the lack of a theoretical foundation to turn to explain their actions, and they don't have the Phillips curve has been effectively discredited at this point, I think, by most of even the top officials at the Fed are sitting there saying, well, it doesn't seem to work.
Minus 5% or something if they were doing the Phillips curve.
Some of them say there's a different natural rate of unemployment, but others are saying, well, these relationships don't hold. And an interesting article I saw recently does, I think, a reasonable job of postulating that maybe it is that there's a global situation where I explain the Phillips curve as a system of valves, and if you look at a pressure tank in the middle, and it's got a couple different valves, and as you push air in, when one of the valves turns red, maybe that's unemployment, and that reroutes and seals off, and it moves over into an inflation valve until that turns red, and then the policy valve turns, and it's a very mechanical system, but it has to do with pressures building up in different places. But if you expand to a global economy where there's other outlets, the pressure valves, there's additional pressure valves, which is, well, then demand turns to a different place, and we import more, or else we bump up investment in automating something. there's more pressure releases for the system. So unemployment getting really low and competition for labor itself isn't enough to drive inflation, but it doesn't mean that there's not still a directional relationship there. It's just that there are more pressure release valves now because we can solve the problems rather than just paying people more. We can invest in new technology or invest in more on-time, logistics for globally coordinating a supply chain, which isn't as expensive anymore to coordinate manufacturing in a different place. And because of, that's actually enabled by technology as well. If you go back 50 years ago, it just wasn't like that. You'd had to go through, importing something from China 50 years ago wasn't that easy. You didn't understand the regulatory environment. You couldn't time things quite as well. You couldn't get on Skype. And it's just much easier now to coordinate that kind of complex system and take in stuff from all over the world or else automate a process or something else. And so there's more pressure release valves to control from having to give people raises. And it seems like that's maybe a reasonable explanation for what we're seeing, and that it would still eventually blossom into the same situation once all those release valves have kind of filled up. But it's more global in nature. And if you've got weakness in overseas markets, then, labor becomes less expensive there, and you can kind of translate it across until it's sort of everywhere at once. And maybe it's just that we should be celebrating the situation. It sounds to me like if you go back to some of the situations we've seen in the past, this would be the greatest thing that everybody could possibly imagine. We can have really low interest rates, strong labor markets, strong economic growth, and not an inflation problem. And it's amazing that it's seen as such a conundrum. But I also think that if it was an existential threat for the Fed because they don't have a theoretical foundation to explain why they broke the economy or are being blamed for breaking the economy, I think that most, cybernetic systems theory says that most systems eventually move toward a cybernetic adjustment, like a thermostat of some kind. You get free play of variables until you get a control center, cell's nucleus, a thermostat in your home climate control, whatever it is. You get something that starts to set things and coordinate the process of regulating things. And once you get that step in a system's evolution, it doesn't go away ever. And I bet it would take 15 cycles of the Fed screwing it up before they had a serious existential threat. Even if there's a lot of media about it, I really don't think that we're going to actually abolish the Fed, even if they directly and provably cause a major recession. I think that it would take a series of similar situations. We'd probably lose staffers and the chairman at that situation, but I don't think that we just get rid of the thermostat for the climate control of the economy. We probably just get a thermostat repair person and start to work on fine-tuning it a bit. But I think that they might be more likely to be nervous about that because they've lost a sense of a theoretical foundation that they can just turn to, where they've had the Phillips curve for a long time. Maybe they just need to revitalize it for the 21st century. So there's what I think about all that.
Yeah, and again, I don't think that the central bank's about to be shut down by any stretch, but I guess my point being would be that if we're looking for reasons for them to pull forward, divergence and the existential threat that we just talked about, I think would be the primary reasons, because everything else that we see doesn't really suggest the need for a cut, right?
Yeah, so this is I think the interesting thing, right, that they seem to be being remarkably proactive this cycle relative to past cycles. And I don't know whether that's, again, because they aren't trusting their theoretical foundations, or I doubt that it's because of the pressure from the White House. I think it's more likely because they have signposts that suggest that it's possible that there's more risk one direction than the other, even if there's not obvious signs on a superficial level, like, for instance, companies laying off lots of people and, banks pulling back against counterparties. We don't see those sorts of signs, but we do see deteriorating inflation and deteriorating long-term inflation assumptions. And so that really removes the risk of lower interest rates. So why not pull back a little bit? There doesn't seem to be, that seems to be a pretty risk-free move. And again, if you think of, I did a piece a few years ago I called Hot Tub Time Machine, where I looked at some of the stuff that the Fed was so worried about and just said, imagine if we had these headlines in the 1980s. And it was like, you could just, if you lived through that period, if you remember that period, particularly in financial markets, it would seem like the greatest thing ever. Oh no matter how low we get interest rates, we don't have an inflation problem, but we still have growth and lots of hiring. It's it's utopia economically, and it's
Well,
I don't understand it.
I think it was up until Japan, right? That kind of rewrote the
well, that's
books
exactly
for what
I
was
just
going
getting
on.
to. Right.
Yeah.
That's exactly what I was getting to. So as soon as you have that example of, oh, this is a trap,
Yeah.
this is something that suddenly means that while it seems good for the next few years, suddenly you lose all your monetary policy tools and you stagnate and you turn into just a desert economically. And again, I think there's demographic explanations for that kind of phenomenon a little bit. But I think that the Fed is very concerned about reducing optionality in its long-term policy path. And I think that with low risk of spurring short-term cyclical inflation problems, they can go ahead and increase optionality over the long-term policy path. That means reducing interest rates more than would seem obvious to most casual onlookers at this point, which is why I'm a little bit in the camp of being a little bit surprised on the easing side if they're on the same page that I'm suggesting, because I think that if you're boxed into a corner and ultimately gun to your head, because that's what they're all living, you have to make a decision on this. I think the risks of an inflationary problem right now are risks they want to be dealing with badly because of that example. And there's no risks in the other direction except for not easing enough. So other than just being, the only one is being blamed for a stock market bubble. That's it, right?
Yeah.
That's the only problem with easing too much right now, is being blamed for a stock market bubble that I can see.
Which nobody complains about until after it bursts.
It's a path of least resistance, exactly where I was going with it. Right. So there's something there, there's a happy button to that in terms of, hey, everybody loves the Fed now because, boy, we're happy about how the stock market's doing. My 401k is looking great because this Jay Powell, he sure is a smart guy. And Greenspan lived that for quite a while. And, I think that is prepotently possible here because there's no risk of an inflation problem. And there's an easy excuse for the sense of, there's a trap in place here if we continue to deteriorate on long-term inflation outlook. So I think they could do that to the situation. And to wrap this back into the sentiment and flow show idea, again, we're in a situation where we've seen all-time record flows into bonds over the last 6 months, and that's where we come into this discussion. So it's a very potent possibility of this sort of bubble kind of market.
All right, let's move over to the. We'll probably touch upon this tomorrow as well, but let's go through best case, worst case, baseline case scenario for the Fed, so people can kind of get an idea, but. As a reminder, the decision will be out at 2 p.m. tomorrow, and then Powell has 30 minutes later his conference call at 2:30 p.m. There will be no update for the projections, so it's going to be a little less clarity around for the markets, I suppose, this time around. No central tendencies, no dot plots. But Brett, what would be the best case scenario for the markets in terms of initial reaction anyway, because obviously there's a debate on where central bank policy would take us on the long term, but best case scenario for a reaction for tomorrow, what do you see?
So like I say over and over again, I believe that the reaction takes about 24 hours to digest, and so you're dealing with noise, knee-jerk kind of reaction. So there's a little bit of possibility it can be quicker than that if it's more obvious. I suppose to cause that, I think that either way, guaranteed, you got a 25 basis point cut. And then Powell's going to frame the language, and then we're probably going to get updates to the language, maybe a Wall Street Journal article over the next week or so to just kind of further try to clarify what the agenda is. And I would say since the 25 basis point cut is absolutely, I think, priced in and
see, I'm thinking
needing
needing 50 basis points for a very best case scenario.
Right, but I don't think, okay, so I'm just saying I don't think that's going to happen. I don't think anybody really thinks it's going to happen. And I think that
that's why it'd be just best case, though, right?
Yeah, unless people think, well, then it's definitely done.
Yeah.
This is it. And remember, so according to Fed research, it takes 18 months for that to have any impact on the economy. So it's not like next week companies are going to start to make more money. according to Fed research. So the standard thinking is that it takes 12 to 18 months for it to start to show up in terms of economic activity. So it's really just about, what sort of headlines there are right now. And long-term inflation expectations can be shaped by it because people are starting to understand where they think prices are going to be, over the long term. But it doesn't tend to show up in any obvious and tangible capacity in the economy for, at least a year. So 50 basis points now, if that means that we're going to get no other cuts, if Powell just comes out and says, all right, we did it, we did our cut, we're now at an interest rate level that we think is right, and we're going to be there for whatever amount of time, I think you could pop and sell that off. But I think to keep the headlines out in front of the market is, I think, the better way to stoke that money coming in from the bond market, to do a 25 basis point cut and then to say, and further cuts will likely be necessary in the conference call, and then to back that up with Fed speak afterwards, and to really see people focusing on long-term inflation expectations as the key theme that the Fed is focused on. I think that would lead to the best, because I think you're forced to just keep buying stocks then. If you're holding a bunch of money, you've been on the sidelines somewhat, you've been worrying about things. If the Fed signals like, hey, you're just going to be stormed by headlines about the next cut and then the next cut over the rest of the year, along with good economic data, and we don't care. We don't care that the economy is doing well. We're just going to keep cutting. I think that would just force that money into the stock market. So I think that would probably be the best case scenario. I think 50 basis points would risk people just saying, okay, they did it all in one shot, they're done, and now we're just going to see nothing but headlines about, the Fed starting to wonder when its next hike will be.
Right. Well, I think of a few things that I'd be looking out at for best case scenario. Number one, obviously a 25 basis point cut. Right now, the Fed funds futures, I think, only stands at 19% for a 50 basis point cut. So
21.9 as of this second.
21.9. Okay.
Right. Oscillating around that 20%. It's been 80-20 split for a while, basically.
Right. Okay. The other thing I would look for them to do in a basically best case scenario is to conclude the balance sheet runoff. We're only 6 weeks away from that, but I think the balance sheet's certainly an area where they could kind of adjust things a little bit more quickly than a basis point cut. So I think that they would look to stop that runoff and hold that tight, and perhaps even hint at expanding the balance sheet a little bit. The other thing that you're going to want to make sure is that there's no sign of the word patient involved anywhere in that statement. That, of course, was the key word before we saw the flip in the January meeting to a more dovish Fed. But I think that, and if you start seeing patient, that's a signal from the Fed that it would be on hold, and you don't want to see that. That would certainly point more towards an insurance cut. And then, like you're saying, they really have to push the disinflationary headwind area. Also talk a lot about the international pressures from the trade wars and the fact that they're starting to see that kind of wash upon the U.S. shores and having an impact in certain areas where they believe there's going to be a domino effect or a trickle-down effect going into the U.S. economy that we simply haven't seen yet.
Yeah, I agree.
So, I think the balance sheet is one thing that's generally glossed over as a lever for the Fed, but, so that's something that we're going to have to keep an eye out on. So, Brett, let's take a look. So, say we do get that best case scenario, a pretty dovish Powell, a lot of concerns about inflation. They halt the balance sheet, even start talking about expanding the balance sheet. What do you think happens in the market? Do you think we just take off from here? Would you be fading that move, or would you have to kind of see some of the nuances of the way that markets were reacting to that news?
I mean, so today, here's a tape where we are seeing no change in Fed expectations, clear superficial change in China-U.S. negotiations expectations, because we were riding that high that, this is the week we get it all back on track. And so far, it looks like, this is one more example of a situation where this is, to try to get it back on track just to turn it back into useful campaign rhetoric. And it doesn't look like it's realistic to to take this factor out of the uncertainty camp anytime soon. So the market pulled back on that and then stiffened up. And now we are seeing a reasonably firm bid underneath it, which is that faucet that I've talked about recently. Kind of like there's a little bit of a faucet on. If you think of the rubber ducky in the tub, and, the faucet is on. So every once in a while you take a bucket of water out from a headline, but the faucet fills it right back up. And we're seeing that kind of tape dynamic today, I would say, more or less. We have a lateral consolidation. I just continue to bias in the same direction until we see red flags across the board. And I think that still just looks like a flower stem that hasn't bloomed yet, that's kind of getting thicker and wider. And eventually you're going to see it bloom, and it's going to be a little bit more aggressive on the upside. I can change that view. As I said, I'll be happy to change it if I see something different, but I don't see yet.
Yeah, and again, I'm on that same wavelength here. It's funny just seeing a number of chat rooms going on, just pointing out White House seeing a buildup of Chinese forces on the border, S&P 500 and 3,400 by 2020 in Barron's. People are trying to chop this down, it feels like right now, and I don't think that's coming here. But let us take a look at perhaps the hawkish side of the decision tomorrow. So some of the things that we want, I don't see them moving away from the 25 basis point cut. So I'm not going to get involved with that. But we could see again the term patient coming back in. We could see Powell continue to do the runoff and saying that there's no need to end that early. That's a few things. There's certainly the potential for a dissenter with Rosengren from Boston, which I expect to see a dissent from him, and also Esther George too. She's always one of the more hawkish members. Not that she's been hinting at that, but so let's say we do get that more of the insurance rate cut language. I would expect to see a bit of selling pressure in that scenario there, Brett. You got any thoughts on what you'd expect to see? Now, I do think that this would, in the longer run, be a positive for the markets. And to be honest, I kind of wouldn't mind seeing a shakeout to jump in at some better levels here. But do you have any thoughts in that scenario where we hit the hawkish case? Relatively speaking, obviously.
Yeah, I'd want to see how markets react to it and then form opinions based on that, to see what people, are pricing in and prepared for. And I think I'd want to see it be real clear. That'd be great to see a real clear hawkish case. And I suppose that anything including, maybe in this press conference we hear the phrase wait and see or something like that, would kind of, I think, help to really concretize the notion that you've got this sort of, in a relative sense, hawkish cut. That, we've done a thing and now we're going to see if there's a brand new reason to do another thing, rather than we're involved in a process, and this is the first step of that process. So one of those two in some form, I suppose, will be identifiable tomorrow, but maybe not that easily, but hopefully it will be easy to identify which of those scenarios is emerging, and then, really get a sense of how the market reacts to which of those that we see. I guess that, like you, I would find the greatest trading opportunity in a situation where it seems like the hawkish version, and then we get a dramatic shakeout and lots of kind of associated rhetoric from other things, and sort of a sense of a sentiment change that's like, oh man, that's it, we got to bail out of the stock market now, and you see a sharp and obvious reaction, and then it seems a little bit emotional, and then you see a kind of bid underneath that starts to march things back. Then you're vulnerable to the situation where, there's doubt thrown on the idea that this was a one-off, and you can really squeeze it right back through the highs. And I think that would probably be the easiest trade setup to play, I think, like you probably do as well. And we'll just have to see. But I think that I'm also going to attempt to pick up information, as always, based on how the market is able to handle a new input, as long as I can clearly identify the nature of that new input.
All right. So, Brett, at this point then, is there anything else you wanted to add on? Obviously, we're going to be doing our coverage of the Fed tomorrow. We could jump on and do a quick preview ahead of time, and then certainly color around the statement and around Powell. But anything you want to add in at this point that we haven't covered?
No, I mean, I think you just kind of keep in the same mindset that there is probably a situation where people have, for a great deal of this year, moved capital into a relatively low-risk exposure profile in a situation where there's a prepotency of possibility of feeling the need to move it back into a higher risk profile. And it's just about a question of getting the catalysts and the momentum and emotional tone to the market to draw that into play. And that's probably the side of the tape that's still the most vulnerable, even though there's a little bit of that toe dipping into that bath water that we talked about. We don't have somebody who's just kind of relaxing in that bath at this point.
All right, so there you have it.
To mix as many metaphors as possible.
Exactly. We love our metaphors over here. You know that. So, well, Brett, I'll tell you what. We could call that a show then. And again, for everybody, we will be on tomorrow and covering the monetary policy. It's always tough to do a show like this when sentiment and flow can change within a 24-hour period, but we'll be on covering the event tomorrow, providing whatever color we can and pointing out any action that we're seeing, and that's where we're going to leave this now then.
Okay.
All right, Brett, I'll talk to you soon.